The banking crisis just hit Europe. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the liquidity crisis is hitting the major European banks as a global dollar shortage is threatening to collapse the entire global banking system. And this is coming at a time when policymakers from around the world are trying to assure depositors that their money is safe, that their banks are solvent, and they can contain any further risk of this crisis. And what I want to suggest to you and continue the story in today's show is these policymakers are outright clueless and have no idea what the real problem is, and I think even secretly want to see the entire system collapse. Plus, we have a major policy reversal again from one of our former favorite Fed chiefs, as she's got a major solution now to the entire crisis. And when you hear what it is, it will completely baffle you as why she would even consider that as a means to solve the problem. And the bond market's telling us, forget a recession, we've got an entire financial crisis coming and soon. Let's over to Bloomberg, where we picked today's story up with a headline: Deutsche Bank shares plunge in renewed bout of stress. The bank, which has staged a recovery in recent years after a series of crises, said Friday it will redeem a Tier 2 subordinated bond early. Now, such moves are usually intended to give investors confidence in the strength of the balance sheet, though the share price reaction says the message isn't getting through. And so you start to kind of wonder what's going on here. In the midst of a liquidity crisis, why would a bank go out and pay off some bonds when liquidity is at a premium? So even if Deutsche Bank was the strongest bank in the world, and we could probably put some question to that, at least that's what the market is saying today, why not say, you know what, we would really like to pay these bonds off because we have the cash and have the resources, but just to show our support and how strong we are, we're going to hold on to this cash until a later date, and then we're going to pay those bonds off. That would give the market confidence, because by paying them off early, it starts to put some question into people's mind. And here's why: these Tier 2 notes are subordinated debt that ranks below senior bonds, but above so-called additional Tier 1 bonds, which you may remember were wiped out as for Credit Suisse's collapse. And Tier 2 bonds typically only take losses if a bank is no longer viable. So now what you're seeing is the market starting to say, wait a minute, if you're paying these off now, maybe you don't think that your bank is viable, and that's why we're seeing their share price outright collapse. And Deutsche Bank slumped as much as 15%, the biggest decline since the early days of the pandemic in March 2020. And it wasn't the only one. 3 other European banks were also down, as the index of European bank stocks fell as much as 5.7% last night. And here we can see now the cluelessness coming out of these policymakers. Again, I want to suggest to you, they don't really know what's going on here. And yet I do believe there is some sort of agenda, or at least some plan, that if they can crash everything down, as I'm going to support, we're going to use their words here to support this view, that then they bring inflation down, and perhaps then they can run all kinds of crazy kind of policy support measures, ones that we may not have even seen yet or heard of. European Central Bank hikes rates despite the market mayhem, pledges support if needed. Now, this was 8 days ago, but this is now important as we see what's going on in Europe. Inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase 3 key ECB interest rates by 50 basis points. So you see this big hike here at a time when there's stress in the global financial system. And again, this puts into question, why is the Fed raising? Why is the Bank of England raising? Why are all these central banks still raising rates when they could just come out and say, hey, you know what? We're not really sure what's going on here, which wouldn't be the smartest thing they could say, but they could just admit that, hey, there's something serious going on here. And while inflation is an issue, the solvency of the global banking system is far more important. So we're going to take a temporary pause here as we try to figure out what's going on so we can put a stop to this. Instead, their message is, we're going to keep hiking. And oh, by the way, we already have all the tools we need to stop this. And look, we kind of already did. So you have nothing to worry about. But let's dig a little bit deeper here. European officials were keen to stress the situation in Europe is different. Of course it is. It always is. Overall, there's less deposit concentration, and deposit flows seem stable, and the European banks, I'll let you decide if you believe this, are well capitalized since the regulatory transformation that followed the global financial crisis. And added to which, if needed, and again, we talked about this yesterday, we're going to cover it again, we do have the tools, we do have the facilities that are available, and we also have a toolbox that also has other instruments. So we have even more tools beyond those tools, and that we always stand ready to activate if and when needed. This coming from the head of the ECB saying that the central bank's ready to step in. Now, yesterday we used this analogy talking about a leak in the plumbing, and you see this little pinhole leak, and the regulators are saying, hey, look, we can fix that. We have the tools right here. Watch, we'll patch it up and everything's fine. But what they perhaps can't see is there's pressure building up in the system because perhaps there's a plug in the system somewhere they can't see. And all of a sudden, this water is starting to back up, pressure's building, and now we only see a pinhole leak, which they again have the tools to fix. But what if it actually starts to bust the pipe? They may not even see it because they're not even looking at it, and I'm going to question that they even have the tools to deal with it, and the market is reacting accordingly. But now I want you to see behind the scenes. So remember, this was 8 days ago. The ECB said, hey, we've got the tools to fix this problem. Now we see last night problems at Deutsche Bank, and now let's take a look at what they're doing behind the scenes, because this will blow you away. And Shalal says, no reason to worry as Deutsche Bank bloodbath reignites global bank crisis fears. He says European banking oversight is robust and stable, and Deutsche Bank is very profitable, as if that matters. There's no reason to worry. And ECB's Lagarde tells you EU leaders that the euro area banking sector is strong. The ECB is fully equipped to provide liquidity to the euro area financial system. So again, you see this as a liquidity issue. That's their view of this. Now, whether you believe them or not doesn't matter, because I think we all pretty much disagree. It's not just a liquidity crisis that can be solved by lending more money out into the banking system in a temporary fashion. There is something systemically wrong in the system, and now you're about to see it, because out of nowhere, we saw a major borrowing of dollars come out of these European banks, and it was huge. So let's head over to the Federal Reserve, because I want you to understand where these banks are getting the dollars from first, and then we're going to look at just how severe this liquidity crisis is getting. The FEMA repo facility allows FEMA holders, which consist of central banks and other international key part monetary authority with accounts at the Fed, to enter repurchase agreements. And these transactions, approved account holders can temporarily exchange via a loan their U.S. Treasury securities held with the Federal Reserve for U.S. dollars, which can then be made to institutions in their jurisdictions. The amount of money they needed, and I had to draw this yellow line so you could see on your screen. Notice how it's flat along the bottom, meaning there's no usage of this except during the pandemic, which you see these minor little blips as some dollars were needed, and probably just as an emergency backstop, and then all of a sudden, straight up, $60 billion in dollar loans from the Fed, pledging as collateral, telling us that there's something severely wrong. This isn't just a minor liquidity crisis. So far, we've seen pandemic level, financial crisis level responses, and not just at those levels, beyond those levels. And now look what's happening to those AT1 bonds over in Europe. Here you see Deutsche Bank. Their AT1 bonds have plunged in price, with yields soaring above 16%, that according to Bloomberg. Now remember, we talked about this in the show the other day, that there was no bailout for these AT1 bondholders, which I think we completely agreed was the right thing to do. But I suggested at the time, if there's no bailout for them, what will happen at any sign of stress, which we now see Deutsche Bank seeing signs of stress, and we see all of these dollars being borrowed from the Fed, that bondholders would dump them en masse out of fear that the bank is going to collapse. And now we're seeing additional stress hitting the banks at a time when they don't need it. But yet Yellen says U.S. is prepared for additional deposit actions if needed. Now remember, the other day, yesterday, she said, look, we can't bail out all the banks. We just can't do it. This has to be up to Congress to decide. And now all of a sudden there's a big shift. Let's first take a look at Congress here, as her reassurance came at the top of hearing on Thursday before the subcommittee of the House Appropriations Committee, when she read prepared remarks that were almost identical to what she delivered before the Senate, saying certainly we would be prepared to take additional actions if warranted. And while policymakers are still on watch for signs of banking instability, which shouldn't be hard to see because they're everywhere, the issue didn't appear to be a top agenda for the House subcommittee on Thursday, and that is completely normal. Because if you're wondering why isn't Congress reacting here, it's because they're trusting all the people that are in various forms of power to deal with the issue. And for the moment, it appears that perhaps there's some leaks, but everyone is reassuring everyone else, we've got this, we can fix this, and so Congress wouldn't need to do anything. But now let's look at what this big bomb Yellen dropped of what her solution is, because remember, we touched on it in yesterday's show, she doesn't have a whole lot of authority here to do much, but check this out. On Tuesday, speaking to the American Bankers Association, Yellen had said regulators stood ready to repeat the steps they took earlier this month when Silicon Valley Bank and Signature Bank shut their doors. In those cases, to prevent contagion, the FDIC invoked the so-called systemic risk exception to guarantee all deposits at those banks, which gives us the suggestion that Yellen cannot solve this problem, but perhaps the way out of it is you call the FDIC and start naming banks as systemic exceptions, and next thing you know, you've got this blanket coverage outside the purview of Congress. Could get interesting if we have to go to those levels, but the fact that she's even suggesting we could do that tells you how bad this problem can get, and the bond market, well, already knows it. As global bonds rally as renewed bank concerns fuel rate cut bets, here we see the moves on Friday extended a rally in bonds ignited by the fallout from 3 U.S. lenders failing in the takeover of Credit Suisse, which has fueled bets policymakers around the world become more cautious on raising interest rates. I'm going to disagree with that. It's not bets on the Fed cutting rates. I think the bond market is starting to suggest that, look, I don't know what's going on here. We're going to have a recession anyways, as predicted by the inverted yield curve. But now the bond market is starting to tell us, hey, you know what? This stuff in the banking system, it's real. In fact, the likeliness now, what we're going to see another financial crisis is building, and that's why we're seeing rates fall. The Fed, as we know throughout history, reacts to the bond market, not the other way around. But it'll be interesting to see over the weekend if we see some major European banks fail. Watch out. This thing's only going to get much worse. I'm your host, Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.